Welcome to another episode of Fidelity Focus. I'm Christopher Wong, Portfolio Strategist at Fidelity International. Now, it's hard to believe we're already at the halfway mark of 2025, and wow, it's been quite a journey. In just 6 months, we've seen tariff tensions flare up, we have seen frantic deal making, and we have seen fresh concerns over slowing global growth and inflationary pressures. As we are recording this, geopolitical tensions, especially in the Middle East, are still top of mind for many investors. Yet, when you look at markets, there's a real disconnect. Sure, we've had that rocky patch earlier in March, April, but fast forward to today, the S&P has rebounded sharply and stands at record highs. European equities have also done well, which makes sense as they have been seen as potential beneficiaries of a change in policies and focus. But there are also other surprises. Emerging markets have outperformed developed markets this year. That's not what many would have expected when tariff headlines first kicked in. We are also seeing a similar trend in fixed income where spreads have generally remained tight. I'm pleased to be joined today by Liu Pei Qian, our Asia economist. So Pei Qian, thanks for joining us.
Thank you for having me, Chris.
So the first question for today, I think it's top of investors' minds. What is driving markets amidst all this chaos that's going on?
That's a very interesting question at this junction, Chris. We know that market right now feels a little bit disconnected from what we hear every day on the headlines to what we see in the market performance. So here's how we're thinking about it. If we look at real hard data, corporate earnings looks resilient at best. And also we see rapid technology advancements. The development of AI is making the market very excited. At the same time, the broader global policy environment seems to be very supportive at large. So that is supporting the market rally for many of the markets globally. But we do see some risks though surrounding that developments. That gives us some question about whether or not this market rally is going to last. Here are some of the risks on top of our mind. Firstly, inflation looks very uncertain, given that tariff is on the way up. Although we are not sure where the final equilibrium is, but we think they're getting higher for most of the part of the economy. By that means policy will remain uncertain. The central banks will have to navigate the balance between inflation as well as supporting growth. And that path to us remains fairly unclear at this stage. And finally, the elephant in the room, we don't know where trade policies, trade dynamics, as well as the tariff policy is going to land at its equilibrium. So that all means we're going to see a lot of changes and volatilities in the global developments going forward.
So Pei Qian, I want to extend on your last point there. So a rising narrative in the market is the rewiring of the global economy. Do you agree with that point?
Yes, absolutely. I think over the long term, we have developed a base case of fragmentation. Given the disruptions we have seen so far, it's very likely that we're going to see a lot more uncertainty and volatility going forward to reshape the global trade economy, security orders over the long run. Companies will have to adapt. We are not sure how and by what means they are going to adapt, but they have to adjust themselves into this new landscape. Not forget to mention that global policymakers are also in a difficult position given the complexity of inflation, growth, as well as the reshape of the global order. So volatility is here to stay. That's our key takeaways. Many of these shifts are not fully priced in by the markets. I don't have a crystal ball to kind of forecast what exactly is going to happen, but the key point I'm trying to bring here is that investors have already started to prepare for the volatility that's forthcoming.
So I agree with the point that volatility is here to stay. However, how you want to protect or diversify yourself from volatility, that could probably change going forward. So I think one thing we need to think about is the role of US assets in your portfolios, right? So US Treasuries, for example, a typical traditional safe haven risk-free asset that has kind of been a bit shaky over the last couple of weeks during the volatile periods. So investors are starting to rethink how they allocate to assets like that. Or even the US dollar, right? We've seen one of the weakest first half performance in the US dollar in over 40 years. And again, investors are re-examining how they're thinking about assets like the US dollar. right? So going forward, we believe Asian investors will also have to rethink how they allocate to US markets, right? Does US equity markets still deserve a more than 60+% allocation in portfolio? I think that's worth a think. Should we only be invested in US dollar assets? I think that's also worth considering. Or even US Treasuries, should that be the only risk-free asset in your portfolio? I think investors will probably have to think about that as well. So I think in summary, it is not a flick of a switch or it's something you can change overnight, but it's something we should think about. So maybe to this point, do you think Asian investors should really totally pivot away from US markets, or how should they deal with it?
I think by what you have described just now, Asian investors have already given an answer. There has been some shift away from the dollar-denominated assets, as you mentioned. But what I want to emphasize here is that that doesn't mean a total abandoning of the dollar and dollar-related assets. Diversification is the only lunch in today's markets. And we do see a lot of exciting developments for the rest of the world as well. Europe, for example, is taking more heavy weights in terms of investors' asset allocation. And here in Asia as well, our home markets also witness some of the exciting developments. I'll probably dissect some of those developments to see, what lies ahead for investors that's seeking diversification. Looking back into Asia, quite a few of the economies are pivoting into domestic demand, for example, in view of the rising external volatilities. Japan has been on the path of reflation, and that path looks to be intact because that's driven by a wage growth which comes from a homegrown developments. In China, we also see diversifications or pivoting broadly into domestic demand. Durable goods stimulus has been supporting domestic growth at large over the last few quarters. As property sector stabilizes, we also look into the broadening of the consumption growth in China. So all these domestic developments are also making investments more exciting. We are also looking at some other developments that's related to AI demand, for example, that is driving the growth in Korea and Taiwan and the broader region who are related to the semiconductor supply chain. And not to forget, in this region, many of the central banks do have a lot of policy rooms because inflation is not a real issue in this area. So quite a few central banks, the likes of Korea, Thailand, do have the policy room to maneuver and cut if necessary. That means, in view of the external volatility, diversification is not only for growth and exciting themes in the region, but also acting as a line of defense. Because as we see more uncertainties going forward, both the policymakers as well as the investors need that line of defense and to diversify their portfolios.
So speaking of defense and just diversification against volatility, one area that we are particularly finding interesting is defensive dividend stocks, right? Essentially income. So I guess sitting in Asia, we're all very familiar with the theme of income, right? We all prefer the certainty of income with the cash flows coming into our accounts at regular periods. So one area, like I mentioned, is defensive dividend equities. So they tend to be a lot more resilient to the general economic cycle. So if we do see any bouts of slowdown in the economy, as we're expecting, that could probably help to enforce your portfolios. And besides that, a lot of these stocks, I think not everyone is that familiar, they tend to sit also outside of the US. So there's the added benefit of diversification. So we find there's definitely merits to think about defensive dividend stocks in your portfolios. Now, the other side area that we're hearing a lot of conversations around is also diversifying to Asian fixed income, right? So, in fact, investors did pretty well in the last couple of quarters, allocating a lot more into the short maturity side of investment grade bonds. I think more and more are starting to still stay with investment grade bonds, but really stretching out their tenors a little bit. And in Asia, like you mentioned, there's a lot more policy room, potential for more interest rate cuts, while growth remains pretty resilient. We're also seeing a lot of investors start to think about using Asian fixed income to really enforce and diversify their portfolios. So, Pei-Chen, we have covered quite a lot of ground today. Are there any final thoughts you'd like to leave our audience with today?
Sure. I think just to conclude our conversation, we do have a lot of known unknowns going forward. Just to highlight a few, we don't know where the trade policies are going to land. And we don't know where the Fed is going to be eventually. And also, we don't know what is the shape of China's stimulus that's going to be forthcoming in reaction to that. So that all means volatility is here to stay. In time of volatility, we can't emphasize enough. Diversification is the only lunch in today's markets.
Yeah, and I would just emphasize, I think, a couple of factors investors should think about. One is definitely diversification, you mentioned. Second is being active, meaning you are very active in making all your investment decisions. I think going all full out passive investing may not be as efficient going forward if the world evolves as quickly as it does. And the third is an extension of this is also being flexible, right? Evolving and changing how you think about your portfolio and your investments as new information and new decisions start to come by. With that, thank you very much for joining us today. I look forward to seeing you again in a couple of weeks' time.
My pleasure. Thanks for having me.